Well, I'm going to do a couple of things differently. First, I'm going to be sitting down. Second, I'm not going to be showing all kinds of charts and graphs. I'm going to be talking more about what kind of really happens in the real world. I want to, but first, give you a little preface. I started my career over 30 years ago as an actuary working in the small plan world. I was approached probably 7 or 8 years ago by a lot of my clients basically saying, you know, we've been saving this money for retirement. Now I'm going to retire. What should I do? And I said, you know, that's not exactly what an actuary does. You know, we're trained to create and administer retirement and other financial security, you know, programs. We don't really work at the tail end with the real person who really needs to use the real things that we create. So I said to myself, you know, it might be interesting to find out what it's like at that end. So I decided to spend some time, became a certified financial planner, and over the last 4 or 5 years, sort of like on the sideline, I have been doing some planning with individuals getting close to retirement. And it is incredibly interesting, incredibly challenging, and the things you learn about people, you don't learn when you're doing actuarial work. That much I'll tell you. So I think it was important for you to just know where I'm coming from. One other thing I'll say about my financial planning, I have a model that's very different. I only charge on an hourly basis. I don't actually manage assets for a fee, nor do I sell any insurance products. I like to think of it more as a counseling kind of approach. I kind of feel that otherwise there could be bias one way or the other. So I'm really able to look at it from all perspectives and try to make good suggestions for my clients to incorporate. Okay. So my agenda here is really to pretty much focus on, because I've been asked to, insurance products that generate lifetime income as opposed to investment products. I could do either, but I've been asked to do insurance products. First, I'm going to go through the background of the use of insurance products. Then I'm going to actually talk about some of the common ones, talk about how they're implemented, some recent regulation changes. When I talk about regulations, I mean those from the IRS and the Department of Labor as they relate to qualified plans, mostly 401k plans, 403b plans, you know, savings plans. Some initiatives that we should consider, and then there are some Academy lifetime resources. The thingy? What? To move the slide? Oh. Thanks. So that's okay. So first, some background. Okay. So for some of you in this room who are a little older, initially, at least in the retirement plan world, it was really pretty common to use insured products. It was not, most plans in the early days were defined benefit plans. And a lot of those companies, when employees retired and were entitled to their pension, did not offer lump sums. Instead, they paid out annuities. And in a lot of cases, they decided that maybe the best thing to do would be to transfer the risk of the annuity payout to an insurance company. So either through individual policies or with bigger companies, group policies. With the small plan world, there was something called 412I plans. And these were plans that were basically fully insured. Everything held within the plan was basically some sort of insured annuity or life insurance that was guaranteed by an insurance company. So that's pretty much the way the landscape really was pre-ERISA. You know, we are talking, you know, in the 60s and 70s. Then something happened called 401k plans. and something happened called the Internet, and things changed. All of a sudden, individuals became empowered in investing. And one of the best things, the only things a lot of people had to invest was their 401k balances. And really, the focus changed from creating retirement income to accumulating assets, with really not much of a focus about what happens at the end. You know, sure, I can grow a balance, but, you know, nobody really thought about these people are going to retire, and then what's going to happen with this money that's been accumulated? How is it going to magically create lifetime income? Because of that, financial advisors became much more involved and much more concerned and much more focused on investments and not what we'll call insured solutions. That's where the money was. Even the insurance companies started with variable annuities, which were basically really just investments wrapped in some sort of an insurance policy. And so the world really changed, and we started moving away from insured product solutions and really kind of getting our eye off the ball. The insurance company, of course, did respond, insurers, with some new products that we'll be discussing. Okay. So first, I think it's important to understand the distinction between what we call guaranteed solutions or predictable solutions. A guaranteed solution will be from an insurance company. It will be guaranteed by the insurance company. A predictable one will be based on some investment strategy, based on assumptions as to rates of return and how long somebody will live. And there clearly is no guarantee that the money is going to be there. With an insured product, there is a guarantee, at least to the extent that the insurer is good. And to the extent if they're not good, you have a state backing it up. So we have counterparty risk differences. With the insurance companies, we have to deal with the insurance company and the state. And with the investments, it's really the underlying securities. Of course, insured products provide automatic payouts, whereas the payout solutions do not. There probably is, with insured solutions, actually more downside protection, but obviously less upside potential. With investment solutions, you can end up with more than you expected, but you could also end up with less. I hate to compare them because they are so different. An insured and an investment solution, they are not the same, and they're constantly compared. And I think a position of a lot of people who have an open mind in this area now, and I think, you know, by accident, maybe Frank alluded to it, they really should coexist. There is a way for them to work together. I was just teasing. I know you really meant it. Okay. So what are some of the advantages to insured lifetime income products? They eliminate retiree longevity risk. So when you have an insured product, most insured, if not all, make sure that the money is going to be paid for as long as you live. The longevity risk is no longer with you, it's with the insurer. It also eliminates investment risk in most cases, in that is usually a fixed rate of return with most of these products that is built into the product. It incorporates longevity risk pooling, which basically means that there is a sharing of risk among the policyholders. It replaces a paycheck, which is probably the single most important thing in retirement. The paycheck stops, but expenses don't. And it provides peace of mind. So insured solutions carry with them some very strong advantages. Of course, there are disadvantages with them also. There is this concept that if one dies early, at least in the case of what's a basic fixed income annuity, the insurer wins. The insurer keeps my money. There is a very poor understanding of insurance and risk pooling by consumers. They see it as me against the insurance company, some sort of a bet, not understanding the concepts of pooling of risk. Registered investment advisors seldom recommend insured solutions. They are focused on investments. That's where their training is, and that's where their experience is. There's also a fear of insurer failure. This fear is absolutely unfounded, at least to my knowledge, based on history. Nevertheless, it exists, and you probably know better than I know, but apparently there are some kind of rules that really prevent insurance companies from advertising about state guarantees. Is that true? Yeah. So, you know, that in a sense creates well, I'm not saying it creates a problem, but it would be nice for consumers to know that something is, you know, behind. I mean, I think most insurers are fine. If you buy from the right companies, it's safe, but it wouldn't be the end of the world for people to know there was a backup. But that's not something I have any more information on. Of course, the other argument is that investment strategies are superior, that basically they can provide greater rates of return and are better suited for those that have legacy requests. Okay. And then, of course, the other issue is impact on legacy goals. Traditional insured lifetime solution products leave nothing to the beneficiaries upon death. And when we talk about a balancing act, that is part of the balancing act. For many people, you know, how much can I leave to my heirs? And that's an important factor that people have to talk about. Whether or not to use insured products, well, there are now new products that exist. I mean, there's also the traditional products, and then there are products that are built upon investment solutions, and I'm going to go into some detail. There are relative strengths and weaknesses. These are all should be individually driven decisions. It's not one size fits all, and it really is a function of a whole bunch of individual criteria. Longevity expectation, level of Social Security benefit, availability of family support, health insurance coverage, long-term care planning, whether you have a defined benefit available, the size of your nest egg, legacy goals, investment know-how, and budget requirements. So there's all these moving parts that have to be taken into consideration when making a decision as to how to create lifetime income. When I work with individuals and they come in and they tell me they have no children or no close nieces or nephews, I know that's a real easy job because it takes the legacy issue out. And now we can just focus on what's important, making sure they have enough money. It totally simplifies the process, but that's generally not most people. Most people have some desire to leave money. Okay, now let's talk about some products. Well, the original, I guess, the product most people know about is something called a single premium insured annuity. We refer to it as a SPIA. It's also referred to as a fixed income annuity. It is basically payable. You pay a premium. You get a payment for life. There is options for minimum payment periods. There are options to provide a contingent secondary annuitant benefit. If you use any of those options, it reduces the value of the risk pooling and therefore makes them somewhat less effective in providing guaranteed income to the annuitant. Could serve other purposes. It could help with legacy planning. It could help protect a spouse. But once you start adding on these extra layers, extra contingencies of benefits, what ends up happening is the risk pooling, the thing that really gives insured products their strength, starts to disappear. You can also have a cost of living increase. They are clearly not as attractive when interest rates are low, and they become much more attractive with age due to higher mortality rates. So buying one at age 75, you're getting a lot more for your premium than if you buy it at 65. And for some people, that's a good strategy, waiting to buy, for some people. Deferred income annuities also are referred to as longevity insurance or longevity annuities. You know, they've been around for a while, and as an actuary 40 years ago, I studied them. And at that time, when we used to talk about deferred income annuities, we talked about buying an annuity at age 55, payable at 65. Now, when we discuss deferred income annuities, we're really talking about some sort of longevity hedging. Buying an annuity at 65, making a single premium, and if you live to 85 or some advanced age, 80, 75, whatever, then the benefit is paid. Obviously, the amount of benefit you're going to get for X dollars of premium is going to be much greater than if you just buy a single premium annuity. A, because there's time for the money to accumulate with investments, and B, a lot of people who bought that annuity are going to get dead along the way. And it's their mortality credits that get to fund your additional benefit. So it is an excellent way of planning or hedging for the possibility of living to an advanced age. Once again, these can provide pre-longevity age death benefits, but it reduces the value of the pooling. You pay for it by losing some of the advantage. There are some products on the market right now, not a ton of them. They're not competitively priced on an actuarial basis due to marketing costs and adverse selection concerns. Anybody who's really interested in buying them now is pretty confident they're going to live long. Otherwise, they wouldn't be buying them. And, of course, insurers realize that. So they have to build in contingencies. Obviously attractive for those with strong family history or longevity. And as I said, it's relatively new products. There are some carriers in the market. I think New York Life is one of the big ones. There are but others out there. Conceptually, these products make a lot of sense. And I've been writing about them for about 10 years now. And for 10 years, I've been saying they make a lot of sense. I have not quite come to where I had hoped they would. Then there are other types of annuities. These really are, I throw them in there because people get confused. They're not really what I would call annuities to provide income, but we call them annuities because that's what insurance companies call them. Deferred annuities, variable annuities, fixed income annuities. They're actually investment oriented. The variable annuities are based upon some underlying portfolio. Deferred is usually a fixed rate. Fixed income is based upon some index with a floor and a cap. They're investment oriented. They have some great tax advantages if held outside of a qualified retirement plan. And they are convertible to fixed income annuities at retirement, if at a maturity age, though seldom is that done. Okay, so the newest kid on the block, or close to the newest kid on the block, is something called the Guaranteed Lifetime Withdrawal Benefit. Okay, and it is a rider that goes with a variable annuity. Just so I don't go into too much detail, can I get a show of hands if people know what these things are? Okay, good. Okay. So basically what they are is something you buy that accompanies a variable annuity. And what it does is you are buying protection to provide lifetime income based upon a percentage of a benefit base. So that what it does, oh, I'm sorry, I'm way behind. Okay. So what it basically does is provide somebody peace of mind that as long as they keep paying that premium, that extra rider charge, which comes out of their portfolio each year, and they don't withdraw more than they're allowed to withdraw, the guaranteed amount, even if they live to 120, the money will keep being paid. Okay? And this is, when they first came out, my understanding is that they were poorly priced. And as a result of being poorly priced, a lot of people bought them. And because a lot of people bought them, and then right after that, the market took a hit, a lot of insurers decided that maybe they underpriced them. And a lot of them have moved out of the market or have basically changed the guarantees or changed the products so that they are not nearly as attractive as they were earlier on. But they are still a solution for some individuals. The biggest issue that I have with them is that it doesn't provide the level of liquidity with the underlying investments that you would have if you just had a regular investment portfolio. If you go ahead and take out more than whatever your guaranteed withdrawal amount is, it's going to affect your guaranteed withdrawal amount. So if all of a sudden, let's say you're allowed to take $5,000 a year, and then all of a sudden you see the boat of your dreams, and you go ahead and take out $50,000, it's going to basically destroy your guarantee. So you just lose that liquidity, and you've been paying a premium for this guarantee all along that you're not getting back. Another type of guaranteed benefit is something called a guaranteed minimum income benefit rider. It is also a rider. It also gets attached to a variable annuity. This works a little bit differently in that when you buy it initially, you are guaranteed a lifetime income irregardless of how your portfolio performs. Not quite as popular as the withdrawal benefits. And, of course, you have an option at the time of retirement. If you want to take your lump sum, you can. So you do have that withdrawal flexibility. But once it converts to an annuity, that's it. You are stuck with whatever the annuity payment is. Then we have something called a Contingent Deferred Annuitant, of which Anna wrote a wonderful piece many years ago, which is in this book, if anybody wants to read it. And what they are is similar to guaranteed minimum withdrawal benefits, except that they are based on, they're decoupled. The insurance that insures the guaranteed income is decoupled from the investment. So you could go out and theoretically, get your investments through Vanguard and then go ahead and buy this overlying insurance that would guarantee the income. There are going to be restrictions on what the underlying investments could be. There would be, of course, the amount of the premium that you would pay would be depending upon the risk factor. Now, there is not, to the best of my knowledge, a whole lot of these out there right now. There are apparently still some issues that I guess are being dealt with how they should be labeled or used and reserved for or whatever, but they really have not hit their stride.